The author of that note, Aneesha Sherman, along with our very own Robert Frank. Welcome to both of you. Aneesha, I'm glad you gave this the treatment because it's been making all the rounds. And I guess the question is this just an early sign of broader stress, or can it stay contained to being a quote-unquote white-collar downturn?
I would argue the latter. So if you look at broader total economy numbers, unemployment is still really low. It's sub 4%. It's actually declined over the past year. When we look at wages of low wage earners, so kind of minimum wage levels across states, nearly half of states have seen real increases. That is, increases net of inflation, even despite this inflation environment in minimum wage versus pre-COVID. So that level of consumer, that kind of lower, below median income consumer is more resilient right now. We're not seeing that because they are still pressured by inflation. But as rates flatten and start to come off, perhaps going into next year, we should see that be more resilient at that level. But I think what we're seeing is the opposite across slightly higher income. I'm not talking about luxury, but I'm talking about kind of white collar corporate employees where unemployment is increasing, super low levels still, but the second derivative is going the wrong way. And as you said, consumer credit trends look like they're going the wrong way as well.
Robert, what would you say about all that?
Yeah, I love this research note because it really differentiated the white-collar consumer from the wealthy consumer and this idea of a rich recession, which made for some great headlines in the media and some collective schadenfreude, but we're just not seeing it in the spending numbers. And to underscore that, LVMH just a couple hours ago reported an absolute blowout quarter. If you look at their fashion and leather goods, that was up 18% in the first quarter. That was twice what analysts expected. And a lot of that was from China coming back, but a lot of it was just the continued strength in the U.S. If you look at high-end cars, watches, jewelry, the art market, even high-end real estate here in New York City has doubled in March compared to January. So the spending by the high end remains very strong. It's that sort of next level down, the white-collar, high-tech worker, finance, that I think we're going to keep a closer eye on.
Oh, sure. And I see, Aneesha, that's exactly where you're zeroing in on as well. But I look at the knock-on effect. So in other words, how much of the rest of the economy supports the spending of those higher income, middle to higher income consumers? How much of the travel economy, the service economy, the leisure economy? There was some data on babysitting wages that we saw earlier today. There is a cascading effect from the slowdown here. The same way that their spending disproportionately affects, for instance, credit card delinquency rates, it will also affect the broader economy at some point, won't it?
Yeah, I agree with that. But the numbers, keep in mind, the rates that we're seeing are still very low. We're talking about, less than the 10th of a percent. So, we're talking about single units or double units of basis points of unemployment right now compared to the total population. So, yes, they are disproportionate spenders. And if you look at kind of above median income consumers, they spend somewhere between 65 to 80% of each sector, depending on the sector. More so for discretionary sectors. Entertainment is kind of in the 70% range. Some financial products are more like in the 80% range. So they are disproportionately driving spending. So I think that's where we'll see it first. Not in the Lamborghinis and the Louis Vuittons, but maybe in some premium to slightly mainstream to slightly premium consumer products, travel, entertainment, things like that. And then I think the secondary effect, if we see this trend continue to worsen, is what you said, which is a knock-on effect on maybe the lower earners as a result of a pullback in spending.
Robert, quick last word.
Yeah, the cascade that we're already seeing, Kelly, is in taxes. New York and California are the only states right now that just saw a decline in revenue. Some great research from Dan Clifton at Strategas. And that is largely not only because of the decline in capital gains, but also because of withholding. So that's where we're already seeing a big, dramatic, and rather sudden impact on tax collections in California and New York. We'll see whether that gets even worse.
Great point. You could affect municipal employment in the longer run and that kind of thing. Aneesha and Robert, thanks. Aneesha Sherman and Robert Frank.